Joining us now is a guest who's been on the Stocktwits platform before. He is CEO of gambling.com, Charles Gillespie. So, Charles, they say never to read the comments, but I did on the last couple of interviews you did with Stocktwits. And you have a number of viewers who are very interested in what you have to say about Q3. So you're popular on our platform. Let's talk about these Q3 earnings, 21% year over year revenue growth, record revenue for Q3. What were your takeaways?
Yeah, we had a solid quarter. The marketing business was a little behind expectations, and I think you saw that in the market reaction. But we still making a ton of money. We had 13 million in EBITDA, nearly 10 million in free cash flow, and that's overwhelmingly driven by the continued strength of the marketing business. But the standout performer in the quarter was our relatively new sports data services business, which led the way in terms of growth. That's doing really well on a pro forma basis. It's up enormously, and the fastest growing part of that is Optic Odds, the B2B side of that sports data services business, where we help not only sports betting operators, but also prediction market exchanges and market makers trading on prediction markets with our super high quality odds data that we compile from around the world.
I want to get to the sports data services as well as prediction markets in a second here, but I do want to hit on marketing services. You mentioned that revenue, staying steady year over year. We are seeing some challenges in terms of search engine. How do you view those headwinds, and do you think that the business needs to diversify customer acquisition sort of away from Google?
Yeah, those are all the right questions to ask. So if you look at the business today versus 2 years ago, 2 years ago, virtually all of our revenue was dependent in one way or another on Google. Fast forward to Q4 this year, and we expect on the marketing side of the business, less than half of the revenue to be related to Google. And if you then, include sports data services and look at total group revenue, it'll be something like 36% of group revenue in Q4 will be related to Google. So we have already dramatically transformed this business and made enormous progress diversifying away from Google. Now, having said that, if you look at Google search revenue in Q1, 2, and 3, it accelerated year on year in each quarter. I think it was 9, 12, and 15% growth year on year. So Google's search is alive and well. There's absolutely nothing wrong with it. When we had our Q2 results, me and our CFO Elias talked a little bit about AI headwinds. This has affected a lot of publishing companies out there. I mean, I think we can all appreciate that some questions are better answered on, ChatGPT or Grok or what have you. But that in the grand scheme of things today is not having that big of an impact. Some impacts, but not that big of an impact. And, Google search is alive and well. And what has held us back in the second half of the year hasn't been AI. It's been basically just the search rankings themselves. So if you look at a lot of the kind of key money-making terms that we tend to rank very well for, there's been a lot of garbage in the search results, to be honest. Hacked websites, bad actors, spam, stuff that just objectively shouldn't be there. You don't need to take my word for it. I mean, this stuff just has no business being there in the search results. And to the extent that there's more of that stuff, it does box us out. And it's really on Google to fix that. We'll obviously invest heavily in our content and distribution and quality of everything we do to make sure that we deserve to be number one for all of these search terms. But at the end of the day, Google needs to do its job as well. And, I think they're busy building flying cars and a lot of other very interesting things. And, maybe they don't have the same level of focus on the, anti-spam team of the search results as they used to, but they're a very, effective company. I can't imagine this will go on much longer. And just to finish the thought, we're way through the worst of it with the Google search engine results. From
Okay.
late October, it is getting better. We are making more money. We have better search rankings. That traffic is converting into revenue in exactly the same way it always has. So we see we have already seen improvement off of the lows, and we do expect to see meaningful improvement from run rate in terms of revenue from Google as these search engine results continue to get cleaned up a bit.
All right, let's talk about what's been and continues to be a big growth story for GAMB, sports data services. Now, this is a relatively new side of the business. And in that Q1 interview you did with Stocktwits, you said you expected to be 20% of the business over the full year. What are your expectations knowing what you know now?
Yeah, I think it's been 25% year to date, and the full year number will probably be pretty close to that. So it has grown very rapidly. It is exceeding expectations. One thing that some of the Stocktwits and X commentary has picked up on is as that business performs better than our initial expectations, we end up having to pay them more money, and that shows up in our P&L. You take that as a cost, but that's basically by design. You don't want to be doing the opposite where you actually think you're going to pay less because it's not performing. That looks worse. So the accounting is what it is, but yeah, OddsJam and Optic Odds are both flying. Really interesting businesses. On the OddsJam side, we added some really interesting features in the last month about prediction markets. So prediction markets are basically like a central limit order book where you can see, just like the stock market, where you can see with depth of book where the liquidity is. Is there a lot of money trying to get filled in size at a certain price? And with everything we're doing, we can see that, and then we can surface those insights to the users on OddsJam and basically help them understand where the sharp money is, and so that they can kind of align their betting with that sharp money.
Yeah, I'm glad that you touched on prediction markets because, boy, has that been a huge theme all throughout the year, and certainly this quarter. DraftKings, FanDuel publicly, right, embracing prediction markets. You talked a little bit about generating revenue growth from prediction markets for gambling.com. Is that segment already factored into your projections, at least revenue projections for 2026?
We haven't formally guided for 2026. We did give some color in the Q&A on the call 2 weeks ago, but it wasn't a part of our calculus when we did the deal at the beginning of the year. That whole category was still in a kind of nascent stage. Now it's certainly kind of come to the fore throughout the 2025. So it definitely is a part of our expectations for 2026. But to be honest, we already work with a lot of these companies. We work with the market makers that are trading on the exchanges. So you get the who's who of Wall Street, which have piled into this category quickly. And then you've got the market making arms of Kalshi and Polymarket as well. But then you actually have the prediction market exchanges. They need sports data. They need to be able to create the market and then settle the outcome of the market, at the end of the prescribed time. So we are selling sports data to the exchanges. We are selling our global odds data to the market makers. And, it's a super exciting category. I was in the Polymarket office last week and, saw Shane very briefly, but had a very good meeting with the rest of the team there. And, it's a lot of interesting stuff happening in the category.
All right. Going back to traditional sports betting, though, there is something exciting on the horizon here in the very short-term horizon, December 1st. You've got Missouri coming online for sports betting. Projections are aggressive here in terms of what people expect from the state, especially considering that its location is so close to mature markets like Kansas and Illinois. Talk to us about the opportunity that presents to GAMB, the December 1st launch of sports betting in Missouri.
Yeah, great question. So these new state launches are great for us. Obviously, it drives a lot of consumer interest. All eyes will be on Missouri, in the first half of of December as the market launches. It's a competitive market. There's multiple operators. There's sensible tax rates. So, it's got not the biggest state, obviously, but the foundation is there to have a successful launch and a nice market going forward. So, it should be a 7-figure opportunity for us, even though it's just 1 month in 2025.
Given that and this new state's coming online, a lot of times, typically it involves aggressive promotional burn by operators, right? How confident are you in the ability of gambling.com to compete for that traffic and acquire new depositing customers in Missouri without taking on those much higher marketing costs?
I mean, I think this is like our 35th U.S. state launch, right? So we have a very well-honed playbook at this point. There's only a few things that kind of change state to state. We've worked with these operators for, since the market launched in 2018, and in some cases, pushing 20 years for the European operators that are in the U.S. They trust us entirely to deliver them high quality players. And a lot of what we do is on a performance basis, right? So if we don't send them high quality players, they don't owe us any money. So the risk is really on us and not them. And that's why the compensation for those players can be quite lucrative, because, we are the ones with our capital at risk to create the marketing assets and drive engagement into them. And thus we capture a lot of the upside when it works.
Right. This isn't your first rodeo.
Correct.
I want to talk about some comments from our own community. Some investors have said the sell-off has quite frankly been disproportionate. From your vantage point, how do you separate some of the price action that we've seen in the stock from just the fundamental value of the business?
Yeah, no, I mean, it's super frustrating, right? I've been obviously reflecting on it in the last 2 weeks, and look, the bottom line is the stock and the company are two different things. And, if you've got a small cap company in America that's, met expectations in Q2, but lowered forward guidance, slightly missed expectations in Q3 and lowered forward guidance again, that's just not a recipe for short-term investor interest. Now, what we did in Q3 is we of course updated our forward guidance, and I think we took all the risk in the, you can never say truly all the risk, but I think we took the vast majority of the risk out of the go forward guidance. So, we're on a very conservative footing now with the guidance, meaning we should be able to safely meet expectations for Q4. And then of course we'll introduce guidance for 2026 and do that on the basis that we again expect to be able to meet that guidance. There's these US stocks, it's really momentum driven, and you need to obviously meet expectations, and if you don't, things can go too far. But if you meet expectations 20 quarters in a row, things can go too far in that direction, and you could have a valuation which makes little sense because it's too high. So, I think we're really kind of starting here at the bottom again. And, it's very frustrating, but we have a stock buyback program. Management is, obviously it's possible for management to buy some stock. And one thing that, everybody on Stocktwits should be aware of is that we're a foreign private issuer, which means that management, to the extent that they transact in the stock, we don't file form 3, 4, or 5. It shows up on a different form, 13G, and it shows up 45 days after the quarter end. So, that's just the facts in terms of how the SEC rules in terms of the category of the company.
I'm glad that you brought up share buybacks. Completely understandable why share buybacks would be attractive at these levels. At least one of our investors in the community wanted to know what your philosophy is towards paying down debt and kind of the balance sheet versus share buybacks. Could you get into that a little bit?
Yeah, good question. I think buying back stock at the current levels is unbelievably attractive. So when you think about use of cash in terms of, debt repayment, share repurchases, or M&A, I think share repurchases is highly attractive. Now, that is on the assumption that, of course, the business continues to perform and that there isn't anything fundamentally wrong with the marketing business, which, of course, is my perspective. If you think the marketing business is going to fall apart, which objectively it's not, look at the Q3 numbers and it's actually getting better. It's not getting worse. Well, then, maybe we would have, moderate to high debt levels if our ability to generate cash with the marketing business was going away, but it's not. So, in the context of the marketing business continuing to grow and throw off cash, as we very much expect it will, then the debt levels are not too high. Arguably, they're too low. Now, I think we're looking at everything from a fairly conservative perspective. We're not going to go nuts on share buybacks. But yeah, well, I don't think we have any, we have an entirely appropriate, if not low, amount of debt given the cash generation within the business and our expectations for 2026. Now, to the extent that changed, okay, of course we would react, but we do not see any we have zero balance sheet concerns today.
Okay. Charles, thank you so much for answering those questions. Part of our value proposition at Stocktwits is simply putting people like you, CEO entrepreneurs, connected with our community. So we really appreciate it. I was going to ask you for a UNC NC State prediction for this week, but
Chapel Bill has not exceeded expectations. So I think we need to be realistic. But I got to go with the heels.
You got to go with the home team. You got to go with the home team. Thank you so much, Charles. Really appreciate the time.
Thank you, Michelle.